afternoon, everybody. My name is Shankhanath Bandopadhyay, and on behalf of Informatics Ratings, I wish you a very warm welcome to all of you. Today, I am going to discuss the current economic challenges that Indian economy is facing, and as we all are aware that there is the global economy is itself facing a lot of challenges as a fallout of the Russia, Ukraine war. And there is many countries have increased and continuously increasing their policy rates amid high inflation. So for instance, also we are seeing that there's a lot of other challenges is coming out. Say for instance, in China they're pursuing the zero COVID policy, and there is property issues as well after the Evergrande crisis in China. And so the Euro area and UK are also likely in recession, most likely because their real income is getting hit and the energy bills are surging. Now the US CPI inflation has softened a bit to 7.7%, the year-on-year growth in October 2022 from 8.2% in September. While personal consumption expenditure, that is the PC based inflation, it is now 6.2% in September 2020. Now, according to the IMF Asia Outlook, the growth in Asia and Pacific is expected to decelerate to 4.4% in 2022, and which is expected to rise to 4.3% in 2023. So these forecasts have been revised down by 0.9 percentage point and 0.8 percentage point respectively since April 2022. Now, coming back to the developments in Indian economy, according to the RBI, the economy is likely to grow to 6.1 to 6.3% in quarter 2. Now we are expecting like it is in the range will be the 6.3 to 7.2, but the median is like 6.5 or around something. So it is quite difficult that it will go to beyond 7%. But if it goes, then it will be a very good scenario. The year-on-year growth in bank credit is 16.4%, whereas non-food credit has seen a significant increase at 16.9%, but food credit offtake has declined. Sorry. The services saw a maximum year-on-year growth at 20%, whereas agriculture sector saw 13.4% and industry 12.6% growth. Now, wheat procurement has declined quite sharply. The good news is that the Rabi sowing has increased year-on-year, backed up by the good north-west monsoon rainfall and reservoir water storage levels. The industrial production shed the contraction in August 2022 and turned in positive momentum in September 2022 on a seasonally adjusted basis after a gap of 2 months. In the services sector, the PMI for October accelerated from a 6-month low in September. Fortunately, there is signs of revival in the contact intensive, especially services sector post-COVID, though monetary tightening is taking a toll. Now, the October 2020 CPI inflation lowered marginally to 6.77% compared to 7.4% in September. In October 22 as well, the rural inflation remains higher at 6.98% compared to the urban inflation at 6.50%. Cereals has shown high inflation at 12.08%, after spices at 18.02%. Vegetable, milk products, prepared meal, snacks, sweets, and that surprisingly footwear and clothing have shown high inflation too. Possibly the post-COVID situation, the economy is reviving and people they are traveling a lot, So there is increase of the demand for the footwear as well as in this clothing this sector. So that might be pushing up some of the inflation in those front. And on the wholesale price index numbers is 8.39%, which is the provisional estimate for the month of October 2020 against 10.70% recorded in the previous month. And the decline in the rate of inflation is primarily, some prices have declined of the mineral oils, basic metals, and other non-metallic mineral products. Now, while inflation has shown a softened trend, but we have to watchful. So given the current situations, what is the inflation trends in the next quarter, and depending on that, what will be the policy of the central banks. So possibly that Fed will take a little bit softer stance, but the rate hikes will not stop. So the RBI also, we are expecting that rate hikes of 30 because they are approaching to the 6.5% terminal rate. If taking to that 5.90% repo rate is there, in that there will be a 35 bps points, 25 to 35 bps, but 50 bps is a little bit less likely, because as there is inflation has been softened this time a bit. Now, in the financial sector, the system liquidity is normalizing in consonance, and as we have seen the recent data, initially obviously RBI has to absorb a lot of liquidity, but then we have seen the data in a particular day's operations, and we have seen the outstanding operations. And again, in recent months, there is RBI again has to absorb some liquidity, but before that there was some kind of so a lot of liquidity injections has also happened, because meanwhile there was a liquidity deficits and commercial banks has to borrow at the MSF and a little bit expensive ways. So it is like, and according to the RBI's November 2020 bulletin, which is reflecting the growing preference for bank credit for working capital requirements, issuances of commercial papers and corporate bonds have a bit declined to some extent. The banking system is well capitalized, with capital ratios for the system well above 16% of the total risk-weighted assets. Now, one issue is that the corporate sector performance has been impacted a bit, and the levels of inflation are, however, impacting corporate performance. Corporate earnings results covering more than 90% of all listed non-financial companies points to a loss of momentum in earnings in the second quarter of 2020-23. On 21st November 22, the BSE Sensex was above 60,000, is 61.144, and declined by 518 points, that is 0.84%. The NSE Nifty was also 18,159. It is a 0.81% decline. India GSEC 10-year yield is at 7.31%. The yield on the 10-year GSEC benchmark has traded on a soft note in October 2022 and November 2022 in relation to its peak in mid-June. USD INR is at 81.73%, but there is a bit stringent pressure on the USD CNH, so it is expected the USD INR can be lower, quite a choppy trading in USD INR. Though see that the real effective exchange rate data, it was a bit well above the 100, so which is an indicator, if we go by the Balassa-Samuelson effect, a bit overvalued on that indicator. But there are a lot of other issues if we take those, so on that basis we can control. But the issue is that actually the RBI, there is a perception that rupee can be allowed to decline a little bit further, because RBI has to sell a lot of dollars to on the spot market to protect the value of the rupee, which is basically putting a pressure on the foreign exchange reserves. And to save the forex reserves, it might be allowed to decline a little bit and to reflect the actual real effective exchange rate. Now, foreign exchange reserves have recently increased. This is the good news that Indian equities continue to rally a bit higher after turning net sellers in the past couple of months. FIIs have turned buyers against in November, and the country's foreign exchange reserves increased by $14.7 billion during the week ended 11 November 22 to hit $544.7 billion. Now, one of the there are two reasons that the increase of the forex reserves can be explained. One is the IMF they have allocated a one-time allocation of $17 billion that has helped in augmenting foreign exchange reserves, and there is also valuation gains. Earlier, forex reserves declined due to spot dollar sales by the RBI to protect the value of the rupee, as mentioned earlier, and also the foreign currency assets have increased. Say, for instance, in 1 October from INR 38.45 lakh crore to 38.83 lakh crore. So now one concerning point is that recently the external balance shows some stress. So exports has declined 16.5% to $29.8 billion. Imports has increased 5.8% to $56.7 billion. Which actually resulted in a trade deficit of $26.9 billion, so which was actually $17.9 billion in the last year. Concerning factors is that fewer countries like Netherlands, Brazil and Singapore have shown export growth among the top 10 destinations during this month. So what we have seen that there is a lot of imports from Russia, especially of the oil and petroleum products by India in recent months. So India has also started exploring the opening of the Vostro account with some of the Russian banks, like they have initiated with the Gazprom banks initially, where on Indian we have the UCO bank has started the operation initially, but there are some other banks also have been included recently. So the one of the reason that India is importing from Russia the oil and petroleum product, because Russia is offering at a discounts, so it is a way of getting a cheaper oil compared to some other countries like Venezuela and Saudi Arabia and others. But we have to carefully assess the terms and condition and the kind of the impact on the current account deficit. So for instance, a certain one good point is electronic goods export has increased, but certain major exportable like gems and jewelry, engineering goods, chemicals and pharmaceuticals, etc. have experienced a decline. On the import side, barring machinery and non-ferrous metals, petroleum and fertilizers have seen major growth, with Russia emerging as a major source, whereas the share of US, China and Australia have shown some decline. Though one good thing that Australia and this FTA with India has been taken off recently. So we are expecting that there can be some developments on the bilateral trading front. Now, coming to the oil and gold prices, the latest short-term energy outlook, the US Energy Information Administration forecast the average Brent crude oil spot will be at USD 93 per barrel in the fourth quarter of the 2020 and US 95 per barrel in 2023. Now the outlook is highly uncertain. Now potential supply disruptions and slower than expected crude oil production could lead to higher oil prices, while the possibility of slower than forecast of economic growth may contribute to lower prices. Now gold prices remain also volatile in October, edging up marginally in the early part of the month, but gradually losing pace and declining due to rising US 10-year G-Sec yields. Positive development on the asset monetization front was that government has monetized assets worth rupees 33,422 crore under the National Monetization Pipeline in 2022-23. So far, with the coal ministry leading the list by raising almost around rupees 17,000 crore. In 2021-22, the government surpassed the program first year target of rupees 88,000 crore by completing transactions worth rupees 1 lakh crore. According to the government's latest estimate, there is likely to be a shortfall of rupees 30,243 crore, realizing the overall asset monetization target of rupees 1,62,420 crore in 2022-23. Now, among the states, Gujarat, Maharashtra, Karnataka, Uttar Pradesh, Madhya Pradesh, and Odisha have been identified as focus states on the monetization base. Now, in this budget, what we are expecting, like the government should push. In fact, the expenditure on the capex has increased, capital expenditure, which is a good thing. And if we see the financial year FY 2022, that revised estimate is almost 60.27. Lakh crore, and in the budget estimate of financial year of 2023 is that 70. It is almost like 75,246 crore. So we are actually seeing we can expect there will be a further capex push from the government of India, which is likely to be announced in the upcoming budget as well. And we also are expecting there will be a realignment on the front of the subsidies, because the government of India's food subsidy bill is likely crossing rupees 3 lakh crore, nearly 50% more than the budget estimate of 2 lakh crore. And because there are also the PMGKY, that is Pradhan Mantri Garib Kalyan Anna Yojana, that has been extended till December 2022. Earlier it was actually, the allocation was in this scheme was maximum rupees 5.2 lakh crore in 2020-21 budget. Also, what we have seen on the fiscal deficit front, at 6.2 lakh crore, India's fiscal deficit in the first half of FY 23 widens to 37.3% of budget estimate, which is a bit higher than as percentage of the budget estimate of the previous year, that was 35%. And the capital expenditure, as we have mentioned earlier, it has been increased 45.7% compared to the 41.4% of the budget estimate of the previous year. And what is an impressive thing is that the GST collection shows a very high revenue for the government of India, and the gross tax revenue also likely to exceed the budget estimate. So overall, we are expecting the tax collection would be better, and it is giving a good amount of revenue. On the other hand, the disinvestment issues is a bit tricky, and but the government's expenditure will also likely to increase because of the higher capex. And and we have to keep in mind that RBI's dividend was quite less, and because of this stringent global atmosphere. And so in a nutshell, we have to be very watchful on the inflation front, and the inflation is getting subsided, and especially in the global advanced countries like USA, then obviously we can expect there is a softened stance of the Fed rate gradually. We are expecting it is in the second quarter of the financial year 2023. And so if it is happening, then the India economy is also will be gradually picking up, in the absence of any adverse situations. And we are expecting a resolution on the this Russia-Ukraine war. So if this happens, then we can expect in the next quarter or in the next year, actually, the economy will be moving up. Thank you so much for watching this.